Your CPP and OAS payment hit your bank account this morning. And at the exact same moment, the federal government walked into the House of Commons and tabled a spring economic update that directly affects what you receive going forward: your pension, your grocery spending, your gas costs, your RRIF, and a benefit check that is arriving in your account 6 weeks from now. If you were only watching your bank account today and not the news coming out of Ottawa, there is real money on the table that you may not know about yet. Tonight, we go through every measure in that update that matters to Canadian seniors. What was announced, what it means in actual dollars, what the critics are saying that the government would prefer you not dwell on, and what you need to do before tomorrow to make sure you receive everything you are entitled to. No spin, no vague language, the full picture clearly. Let us begin with what arrived in accounts today, because the April 28th payment itself deserves a moment before we move into the budget. The Government of Canada issued the April 2026 round of Canada Pension Plan and Old Age Security payments this morning as scheduled. If you are enrolled in direct deposit, your money arrived early today. If you receive payments by check in the mail, allow 2 to 3 additional business days for Canada Post delivery. If by May 1st your payment has not arrived and you have no explanation for the delay, contact Service Canada directly at 1-800-277-9914. A delay beyond 2 to 3 business days past the official payment date is not normal and is worth following up on without waiting. Now let us get into the spring economic update, because this is where the significant news for Canadian seniors is concentrated today. Finance Minister François-Philippe Champagne tabled the spring economic update in the House of Commons this afternoon. The headline fiscal number, the federal deficit for the year that just ended, April 2025 through March 2026, came in significantly lower than the government originally projected. The fall budget had forecast a deficit of $78.3 billion. The government's own fiscal monitor, which tracks monthly spending across federal departments, showed only $25.5 billion spent through the first 11 months. Even with a typical surge in departmental spending in March, the final deficit for the completed fiscal year landed well below original projections. Two revenue factors drove the better result. First, higher global oil prices linked to ongoing conflict in the Middle East generated substantially more federal tax revenue from Canada's energy sector than the budget had assumed. Second, a Canadian economy that outperformed most forecasts kept employment strong and corporate tax revenues above projected levels. Both factors together produced more revenue than the fall budget anticipated, narrowing the deficit without corresponding spending cuts. That is the fiscal backdrop. Now let us go through what this update actually contains for Canadian seniors, because there are 5 specific measures, confirmed or newly announced, that directly affect your income, your spending, and your retirement savings. We are going through each one clearly and in plain language. The first measure is the federal fuel excise tax suspension. Effective April 20th, the government removed the federal excise tax on gasoline, diesel, and aviation fuel. That is a saving of 10 cents per liter at every fill-up. The suspension runs through Labor Day, September 7th. The projected fiscal cost is $2.4 billion, funded by the higher oil revenues described above. For a senior who drives regularly, 10 cents per liter from now through the first week of September is a meaningful saving. If you fill a 60-liter tank every 2 weeks between now and Labor Day, that works out to roughly $180 over the period. For those who drive more, the savings are proportionally higher. The relief is entirely automatic. You do not need to apply for anything or do anything differently at the pump. The second measure is the GST and HST credit increase. In January, the government announced a 5-year boost to the geared-to-income GST credit, a 25% increase running from July 2026 through 2031. For a single senior with a net income of $25,000, the total additional benefit for the 2026 to 2027 benefit year is approximately $950. The Canada Revenue Agency calculates this automatically from your filed tax return. No application is required. No form needs to be submitted. The higher credit flows automatically once your 2025 return has been filed and assessed. This is a direct reason why filing your taxes before tomorrow's April 30th deadline matters specifically for seniors. Your filed return is what triggers the CRA calculation. Without it, the higher credit is delayed. The third measure is the Canada Groceries and Essentials Benefit. A one-time top-up payment of $267 is scheduled to arrive in the accounts of eligible Canadians on June 5th, 6 weeks from today. This is automatic. No form, no application, no action required. Eligibility is determined by your income level from your filed tax return. If your return has not been filed and assessed before CRA processes the June 5th payment run, you may miss this deposit or receive it significantly late. This is a second direct reason to file before the April 30th deadline, which is tomorrow. The fourth measure is the RRIF minimum withdrawal reduction. The government has reduced the minimum mandatory annual withdrawal from a registered retirement income fund by 25% for the 2026 tax year. This is a one-year measure. If you hold a RRIF and were required to draw down a fixed percentage of your account balance this year, that required percentage is now 25% lower. In a year when financial markets have been volatile, this is genuinely meaningful flexibility. The standard concern with mandatory RRIF withdrawals in a down market is that retirees are forced to sell investments at suppressed prices to generate the required withdrawal amount. The reduced minimum gives you the option to leave more money inside the RRIF, allow positions to recover, and avoid converting paper losses into realized ones. The financial benefit is less visible than a direct payment, but for retirees with significant RRIF balances, it is a real and material improvement to their position. The fifth measure, and for many seniors, the most significant one in today's update, is the Guaranteed Income Supplement increase. The government has confirmed a 5% GIS increase for 1 year. That translates to up to $652 more in tax-free income for low-income seniors on top of their existing GIS payment for the 2026 benefit year. To put that in context, the maximum monthly GIS for a single senior in the current quarter, before this additional increase is fully applied, is $1,985 per month. A 5% increase on a full annual GIS entitlement is a meaningful additional sum for seniors living on modest incomes. And the GIS, including this additional amount, remains entirely non-taxable. Every dollar of it goes directly to spending, groceries, medication, heat, rent, without any tax reduction on the way out. Now let us address the Canada Strong Fund, because this is the largest new structural announcement in today's update, and it carries both genuine potential and questions that deserve honest, direct answers. The Canada Strong Fund is Canada's first national sovereign wealth fund. The government has committed to seeding it with $25 billion over 3 years. It will operate as an arm's-length crown corporation managed by a chief executive and an independent board of directors. The fund will invest in strategic Canadian sectors: clean and conventional energy, critical minerals, agriculture, and large-scale national infrastructure, alongside private sector partners. The element of this announcement that will be of most specific interest to Canadian seniors with savings is the planned retail investment product associated with the fund. The government has indicated it will launch a product similar to a government bond that allows individual Canadians to buy into the fund and receive a dividend return. For a senior with funds sitting in a TFSA or a non-registered account and looking for a domestic, government-backed option that generates income while supporting Canadian projects, This product is designed to address that gap. The exact yield, the terms, the minimum investment, the structure, none of these have been confirmed. The government said consultation will take place over the coming months. That means no decision on this product is possible or appropriate today. The Prime Minister drew a comparison to Norway's sovereign wealth fund, which has surpassed $2 trillion in assets and plays a meaningful role in supporting Norway's national pension system. The comparison is worth holding with appropriate context. Norway's fund was seeded from oil revenue surpluses during years of strong fiscal performance. Canada's fund will be capitalized primarily through borrowing at a time when the federal government is already running significant annual deficits. That is not automatically a reason to dismiss the concept, but it is a reason to understand clearly what the fund is and what it is not. The Desjardins chief economist raised this concern directly, asking what makes this fund structurally different from previous Canadian strategic investment vehicles that did not deliver on their stated objectives. The CPP Investment Board welcomed the announcement but noted it had not been consulted in advance and stated that the conditions for long-term success are a clear commercial mandate, strong governance, and operational independence. There is one point about CPP security that deserves clarity because conflicting information circulates online. CPP retirement benefits are paid from the CPP Investment Board Fund, currently approximately $500 billion, which operates entirely independently from the federal government. The deficit numbers in today's update do not affect the solvency or payment structure of CPP. Your pension is funded by your lifetime contributions and the CPPIB's investment returns. It is legally separate from the federal budget. OAS and GIS are funded through general government revenues, but the legislative protection against any downward adjustment is written into statute and requires an act of Parliament to change. Both programs are fully operational. Federal deficits do not threaten your CPP payment. Now for the honest limits of today's update, because they deserve the same clear treatment as the benefits. The deficit for the 2026 to 2027 fiscal year is projected at $65.4 billion. Canada is running structural deficits averaging approximately $64 billion per year over the 5-year forecast horizon. The Prime Minister committed during the election campaign to balance the operating budget within 3 years. Today's update does not contain a clear or detailed path to that target. The opposition leader has argued that the deficit should be capped at $31 billion, pointing out that the actual number is more than double that figure. The critique from the opposition bench is that the structural issue is not a shortage of investment capital, but a regulatory environment that prevents private investment from reaching the projects that need it, and that adding $25 billion to the national debt does not address that underlying problem. The RRIF withdrawal reduction and the 5% GIS increase are both one-year measures. They are real and they deliver genuine relief in 2026. Whether they are renewed, extended, made permanent, or allowed to expire in 2027 is not confirmed in today's update. Seniors building financial plans that rely on either of these measures should note their temporary nature and plan for the possibility that they do not continue. The retail investment product connected to the Canada Strong Fund will not have enough confirmed detail for any investment decision to be made for several months. Governance structure, projected yield, investment terms, and minimum amounts will follow later. No opportunity is being lost by waiting. There is nothing to act on today regarding this product. There is also a layered benefit available to certain seniors from the RRIF withdrawal reduction that is worth understanding clearly. The OAS clawback, the mechanism through which OAS is recovered from higher income seniors, begins when net world income exceeds $95,323 in 2026. For seniors whose RRIF mandatory withdrawal was going to push their total income close to or above that threshold, the 25% reduction in the required minimum can lower their total declared income for 2026 meaningfully. In cases where the reduced income stays below the clawback threshold, some or all of the OAS that would otherwise have been recovered may be protected. For seniors in that income range, this interaction is worth a specific conversation with a tax professional before year-end. The GIS interaction is equally worth understanding because GIS entitlement for the July 2027 through June 2028 benefit year will be calculated based on 2026 declared income. A lower RIF withdrawal in 2026 translates directly to lower reported income on the 2026 tax return, and potentially to a higher GIS entitlement in the following benefit year. For seniors in the income range where GIS is partially reduced rather than fully received, this effect is financially significant. Before closing, there is one more group of seniors this update speaks to directly, and that is those who are not yet receiving GIS but may now qualify based on the income changes the 5% increase creates at the eligibility boundary. GIS eligibility is determined by your net annual income, excluding OAS itself. For a single senior, any income below approximately $22,000 per year qualifies for at least partial GIS. Seniors who have previously fallen just above that threshold, perhaps because of a small private pension, rental income, or investment income that put them marginally over the line, may find that changes in their income situation in 2025 have shifted their position. If your 2025 income was lower than 2024 for any reason, retirement from part-time work, the end of a contract, a reduction in investment income, or the loss of a spouse, your filed 2025 tax return may now show an income level that qualifies you for GIS when you were not receiving it before. Service Canada cannot make that determination without your filed return. This is yet another reason why the April 30th deadline matters so specifically. Filing your 2025 taxes is not just a legal obligation. For many Canadian seniors, it is the action that unlocks a benefit they have been entitled to and have not been receiving. If you are uncertain whether you qualify for GIS, the check is simple. Log into your My Service Canada account. If GIS is not showing as part of your current benefits and you believe your income may fall below the threshold, call Service Canada directly at 1-800-277-9914 and ask them to review your eligibility based on your most recent tax information. It takes one call, and it could mean over $1,900 per month in additional non-taxable income beginning in July. For seniors who are already receiving GIS and have seen their income decrease in 2025, the filed return will trigger an automatic upward recalculation of your GIS amount starting in July, reflecting the new 5% increase in addition to any income-based adjustment. The combination of the income recalculation and the 5% enhancement makes filing your 2025 return before tomorrow one of the highest return actions available to a lower-income Canadian senior right now. Let us bring together the complete picture of what is confirmed and actionable for Canadian seniors as of today. The federal fuel excise tax is suspended through September 7th. 10 cents per liter is saved at the pump right now with no action required. A $267 groceries and essentials benefit arrives on June 5th automatically from your filed tax return. A $950 GST credit increase is in effect for eligible single seniors for the 2026 to 2027 benefit year, also from your filed return. The mandatory RRIF minimum withdrawal is reduced by 25% for 1 year, providing real flexibility in a volatile market. And the 5% GIS increase delivers up to $652 in additional tax-free income for low-income seniors this year. All of these measures are real. Several of them flow directly from your 2025 income tax return. The filing deadline is tomorrow, April 30th. If your return is not filed by then, you risk delaying or losing access to the GST credit increase, the June 5th grocery payment, and the GIS recalculation that determines your entitlement starting in July. Filing is not a formality. It is the mechanism that connects you to every income-tested benefit in this update. If you need free help filing before tomorrow, the Canada Revenue Agency's Community Volunteer Income Tax Program runs free clinics across the country, and many are still open through the end of April. Call 1-800-2779-914 or visit canada.ca to find one near you. Do not let the deadline pass. Your April 28th payment arrived today as scheduled. 5 affordability measures are now in effect or arriving soon. The full picture includes both the real benefits and the genuine limits of what was announced today. And the single most important action connecting you to the income-tested measures in this update is filing your 2025 tax return before midnight tomorrow. Leave your question in the comments below. If today's update raised a question about your GIS, your RRIF, the grocery benefit, or anything else that was announced, write it in the comments. Every comment is read and every response is given. If this gave you a clearer picture of what today means for your retirement income, share it with a Canadian senior in your life who deserves to have accurate information. Subscribe and turn on notifications. When the Canada Strong Fund retail product details are confirmed, when the July 2026 OAS and GIS rates are released, and when any further changes emerge that affect your income, you deserve to hear about it first in plain language with real numbers. This is Wealth Years Canada.